Hello and welcome to our fourth quarter strategy review. We met in this room last Wednesday, the last day of September, and with us was Art Niños. Art shared his expertise and he is a senior partner with Northwest Asset Management. To my right, Len Skina, CEO and Chief Executive Officer, and on my left, Bob Toomey, Vice President of Research. We met, as I said, on the last day of the month, and we looked at all of the various factors that were going on. And of course, we continue to see factors such as the elections, such as interest rates, what the Fed is going to do, certainly continued looks at Brexit and what that might do, which of course was a major factor when we met the previous quarter. But I'd like to just put everything a bit in perspective. So right now you'll notice on your screen a chart which basically shows the long-term trend line of the S&P 500 index. It's interesting to note that since 1945 we've had a trend line which has been basically going up at a rate of over 7%. We also reviewed the fact that earnings during that same period of time actually went up about 6.4%. So it was interesting to note that both of these tended to follow each other. And I think that is an important factor in putting everything in perspective, because we definitely, as you'll hear, feel that earnings, while not on a fast track, are certainly on a consistent track going forward. So with that, I'd like to turn it over to Bob to talk about the U.S. markets.
Great, thanks a lot, Stan. So to pick up on Stan's comments relating to the long-term growth trend in earnings, as we've said before on these presentations, earnings are the primary driver of stock prices over long periods of time. Certainly inflation, investor uncertainty, Federal Reserve policies, all of those things have an impact. However, corporate earnings really drive the long-term trend in stock prices. And as Stan mentioned, we continue to think that that's reasonably favorable. It's been negative for several quarters, largely due to the energy sector, but those negative comparisons will anniversary in the third quarter, and we believe that that is going to result in rising earnings as we move into the fourth quarter and the first part of next year, which is positive for the market. One of the things I wanted to point out about our deliberations is that when we look at the economy right now, I like to use the euphemism, it's a 2% world. And it really is. And what I really mean by that is the economy's growing around 2% plus or minus, and inflation has been growing at about 2% plus or minus. This has been intact for several years now, and I think we believe that that's going to continue for the foreseeable future. We don't see anything right now that would grossly throw it off that track. And I think what that means is that the outlook for Fed policy will remain stable. We continue to believe that Fed policy remains highly accommodative. Particularly if you look at the last FOMC meeting, I was really surprised when they came out of that, and actually the members of the FOMC reduced their long-term forecast for rate increases. They went from expected rate increases of 4 in 2017 and 18 to 2 in 2017 and 18. That is very significant, and it means that the Fed governors are really ratcheting down their expectations for interest rates. So that remains, highly accommodative. And so those factors plus, the outlook for low inflation and rising corporate earnings is really kind of what I'd call a Goldilocks scenario for stocks. Right now, I would say that in terms of the market, as I mentioned, based on the factors that we see right now, we continue to think the market can gradually grind higher. The election notwithstanding, there could be some volatility surrounding the presidential election here in November. We have taken some measures to address that, which Stan will discuss later. I would like to now turn it over to Len to talk a little bit about the international situation.
Thank you, Bob. Internationally, we have actually been underweighting our international allocation for quite some time now, and have for the last several quarters been at a minimal allocation that our model allows. We have, for this quarter, decided to start bringing that back to normal. And we certainly weren't going to do that in the wake of the Brexit vote at our last meeting, but as the emotions from that particular vote have died down and the recovery in the international community is underway, it seems that this is a good time for us to start to normalize that particular part of our model. On the other part of international, we have been eschewing the emerging markets for quite some time as well. Market conditions and economic conditions have turned to a point where it is much more favorable for the emerging market countries now than it had been. And we have reintroduced them back into our allocation and into our model, and will allow them to help drive a little bit of the return there, as they are no longer as influenced by the downturn in China as they once were, as China is continuing to kind of stabilize a little bit there. With that, I'd like to turn it over to Stan to talk about our natural resources allocation.
Thanks, Len. And natural resources, which of course all of our clients realize is not a large portion of our overall allocation, is something that we have used to give us some stability in periods when things are going the other way. So last quarter, with Brexit being very much on our minds, we decided that we would put our natural resource allocation into the gold area. And as we went forward, actually, the quarter that we just finished was not a negative quarter. And on the other hand, gold did actually go up a little bit. So looking towards this quarter, where we feel things, as Bob was discussing, and really as Len is discussing, are better, we felt like we would take some of that money out of gold, and we in fact did take about half out, and put that into an area which has been very much underperforming, but recently looks like it may very well have hit bottom and will start to act more reasonably as we go forward. So that money was put into our energy, and therefore we're now 50-50 between energy and gold going into the next quarter. With that, I'd like to turn it back over to Len to talk about fixed income.
Thank you, Stan. On the fixed income side of things, we continue to see our fixed income allocation driven by interest rates and by Fed policy. The Fed policy at this point has been, they're keeping interest rates low. They would like to raise them. They're trying oh so very hard to raise them. But every time they want to, something gets in the way. And market conditions and economic conditions just aren't completely supporting an advancement in interest rates at this time. The Fed was ready to go, and then the Brexit situation hit, and they delayed it again. But we're expecting that they probably will put some kind of an advancement in interest rates in and increase them sometime probably in December. At this point, because we are expecting the long-term trend on interest rates to go up, even if it is going to be slow, we're skewing our allocation towards the short end of the bond curve, of the yield curve. And the reason for that is that the longer end tends to be much more volatile. With that, we recognize that by going to the short end, you give up a little bit of yield, and so we've introduced a high yield short end fund as well into our particular allocation this quarter to try to bring back some of that additional yield that we're giving up on the high end. With that, I'd like to turn it over to Bob to talk about the U.S. situation.
Thanks a lot, Len. So following our meeting last week, we did make some changes to our U.S. equity holdings. One of the things that I think is most significant is our change in the healthcare area. As you know, for actually several years, we've been holding a position in the large cap pharmaceutical stocks through our holding of XLV, which is an exchange traded fund that holds those types of stocks. That ETF did very well for you in your portfolios. And we've been looking at the biotech sector as an area that has been particularly underperforming over the last year or so. And we felt that from a value opportunity, we felt that it was opportunistic to swap out of the XLV into an exchange-traded fund that holds biotech stocks such as Amgen, Celgene, companies like that. It's the IBB is the ticker, which you will see in your portfolios. And we, again, we believe that there's some really good value to be capitalized in that area. We also added a position in small cap value stocks. As you know, your portfolios are allocated amongst mature equities and developing equities. One of the areas that we do use to represent developing equities is small cap. Small cap stocks have underperformed for the past year or so, and particularly small cap value. One of the studies that we looked at in our deliberations this quarter was a study that showed how small cap value is very undervalued relative to its long-term trend line. We felt that that was a very good opportunity as well to add capital value to the portfolio. We continue to retain our position in home builders. That sector has not performed that well of late, I think largely due to concerns over interest rates, but home building still remains very healthy. It remains one of the strongest growth sectors of the U.S. economy, and we believe that that continues to offer good value for you over the longer term. Finally, we also retained our position in consumer staples, which we added last quarter. We like that sector because it's a very steady grower. It tends to have lower than average volatility and tends to be a very steady dividend growth area. And we felt that we do consider income and quality dividend growth in your portfolios when we are structuring the models and our deliberations from these meetings. I'd like to turn it over to Stan now for some closing comments, and also going to talk about some of the things that we took to reduce portfolio volatility.
Thanks, Bob. As I think everyone listening gets the feel, we did have a very long session. We covered a lot of areas and made a lot of decisions. One of those areas was to generally move more towards a more fully invested situation for this quarter, reducing cash somewhat from what we had done the previous quarter in recognition of potential volatility with Brexit. That brings me to the point that we do set a trigger at every meeting. We don't always talk about it, and we have very rarely had to use it. But the reason we do set a trigger is to look at something that could happen but is unlikely to happen. And in that regard, we don't expect that to happen, and therefore the trigger will not be used. The reason for setting it, though, is to allow us to make in a calm relationship when things are not causing this unexpected event to decide what we will do. This quarter, we also set a trigger very differently than we have before. We set a trigger that actually has two facets rather than one. And while I'm not going to get into all the variations, we were concerned about two things. Number one, volatility. And number two, of course, stock market action. So the trigger we set deals with both. We are looking at volatility through the VIX, and we're looking at stock activity through the S&P 500. We've set limits on both, and again, we do not expect them to be breached, but we have made that decision, and we want everyone to be comfortable with the fact that we are not ignoring in any way the possibility of increased volatility through politics, through interest rates, through international, through any of the things that could affect our markets. But again, re-emphasize, we don't expect that trigger to be hit as we go forward. With that, I'd like to thank you all for listening today and tuning in. I want to remind you again, and actually our production person was telling me we have now been doing this for 4 years. You can confirm that by looking at our website because they're all posted out there. And we certainly encourage you to do that. And we will look forward to seeing you again next quarter.